This video is sponsored by Blinkist. Go to blinkist.com/theplainbagel to get a week for free plus 25% off a premium subscription. After over a decade of rock bottom interest rates in most of the developed world, including negative interest in some areas, rates are finally on the rise, which has gotten a lot of people asking, what will this mean for my investment portfolio? After all, central bank policy rates are a core component of the economy, and as they rise, so too do most other rates. From mortgages to bond yields to even GIC and savings account returns. Now, it's great for anyone that's looking to sit on cash, but what about stock investors or people who invest in other assets? Well, unfortunately, rising rates are generally viewed as being a broad negative for investment prices. Higher interest rates mean higher costs for anyone that's borrowing money. And with consumer and company debt being pretty high globally, that's going to hurt a lot of budgets, thereby depressing stock prices. Or at least, that's what you would expect. It's theoretically sound that rate hikes would equal bad returns, but if you look historically, the data kind of contradicts our common understanding of the subject. So what's going on here? Are rates bad for the market, good for some areas, but not for others? Where should I put my money, Richard? Well, given that this will be the first rate hike environment that many retail investors will be experiencing, I wanted to further explain the topic, including the theory and what actually goes on when rates rise. Because even if you have a general grasp of the subject, the historical data might surprise you here. So let's talk about rising rates and what they will mean for investments on today's Plain Bagel. When we talk about rate hikes, we're generally referring to central bank policy rates, known as the federal funds rate in the US, which is the rate at which banks in the economy lend money to one another. Central banks have a lot of influence over this rate and will often increase or decrease it using a variety of tools to help achieve their monetary policy objectives. And when the rate is hiked, as we saw in March, it tends to push up all other interest rates in the economy, since banks who borrow at this rate will want to maintain a spread between it and what they themselves lend out money for. That means mortgages, corporate bonds, lines of credit, and possibly even credit cards could see their interest rates increase as the economy digests these new rate hikes. In the current environment, with inflation rates on the rise after aggressive monetary stimulus and supply chain kinks resulting from the pandemic, it's being signaled that a number of interest rate hikes are inbound. So, what will this mean for investments? Well, in the world of fixed income, namely bonds, there's a pretty explicit negative relationship. As rates rise, bond prices fall, for the very simple reason that their return becomes less attractive. If you own a $1,000 bond that pays a 3% yield, and all of a sudden companies are selling 4% and 5% bonds for $1,000, your bond isn't as attractive to other investors. That means that the value of the bond you hold will decrease. And to sell the bond, you'll have to offer a more attractive yield, how much the bond pays relative to its price, by selling it at a discounted market value. So while rising rates are great for new buyers in the bond space, it's a pretty bad thing for those who are already invested in the area. Stocks, meanwhile, don't have as clear-cut a relationship with interest rates, as we alluded to in the intro. But there does tend to be a high-level view that rising rates in and of themselves are bad for the stock market. Part of this is because everyone, from consumers to the government to the companies we invest themselves, will likely face higher costs from holding debt. Consumers will see their discretionary income reduced as things like mortgage and car loan payments increase. Governments will be forced to spend more to service their debt and may have to cut back spending in other areas. And the companies we invest in could see their profits reduced by both lower revenues from budget-conscious consumers and higher interest expenses themselves. You may even see companies discouraged from pursuing business-growing ventures, like the development of a new product, the opening of a new facility, or the acquisition of another business, since these activities often require a lot of funding, which typically includes debt, which has now become more expensive. And if all that weren't enough to make you pessimistic, there's actually a valuation-related reason why stocks theoretically become less attractive in a rate-rising environment. Many stocks are valued based on the returns they offer relative to other opportunities in the market. And when you consider the risk-reward trade-off, rising fixed income yields can draw investor money out of the stock market. For example, if a GIC goes from offering a 2% return to a 4, 5, or 6% return, investors will place less value on an expected 8% return from a stock. Sure, it's still higher than the GIC, but the risk-reward trade-off becomes much less attractive as fixed income returns rise. In fact, if you graph the 10-year Treasury rate, a common gauge of interest rate yields in the US, and the S&P 500 PE ratio, a measure of how much investors pay per dollar of profit for their stocks, there seems to be an inverse relationship. And so with rising rates, we face a double whammy. Companies face potentially compressed profit margins on top of lower revenues, and the valuation that investors are willing to pay for those depressed profits might decrease as well. But that's at a high level, and as we mentioned, there are different types of stocks and businesses that would react differently to rising rates. So let's go over those and explain what the differences are. We'll start with those expected to be hardest hit by rate hikes. It's generally assumed that growthier names are particularly unattractive in a rate-rising environment, in part because of that valuation piece we touched on earlier. Not only do these companies tend to require more capital to fund their growth, which will be more expensive as rates rise, but because a lot of their stock price is based on the valuation of their outsized future profits, say 5 or 6 years down the road, rather than profits today, investors become less willing to wait for the promised performance. Now, any industry can have growth stocks within it, but many view the tech sector as being the embodiment of the style. So one could come to the conclusion that the tech industry or sector will likely perform poorly moving forward. Bond-like securities, including REITs and utilities that focus heavily on their dividend yield, can also be hurt as investors switch their money into more secure fixed income investments. It's also why some view real estate as being a potential victim of a rising rate environment, as it becomes more expensive to buy properties. As for industries that are expected to benefit from rising rates, banks and insurance companies are really the front of line here. Both do see some negative impacts from rising rates, with banks themselves seeing their borrowing costs rise, insurance companies often holding a portfolio of bonds that will likely decline in value. But these negatives are usually offset by greater earned interest. Finally, there are value stocks, the yin to growth stocks yang. Value stocks are theorized to do better in rising rate environments as they tend to already have depressed valuations and current profits, something investors will give more value to. No pun intended. So at a high level, stock returns will likely be depressed, money will flow out of growthier tech stocks and yielding positions, and flow into value positions and financial institutions. It's all theoretically pretty sound, and historically speaking, wrong. You see, oddly enough, stocks have done pretty well during past rate hike cycles. There is at times a noticeable initial drop when the onset of a rate hike occurs, but interestingly, according to Truist Advisory Services, over the past 12 interest rate hike cycles, the S&P 500 has actually returned an average annualized 9.4%. Considering the average return for the index from 1957 to 2021 sits at roughly 10.5%, that's not so bad. And crazier still is if you look at how different sectors performed over the more recent of the rate hike cycles, look at which industries are at the top. That's right, technology and real estate, the very industries people identify as the most likely to take a hit from rising rates. So what's going on here? Is everyone wrong about interest rates? Well, not exactly. While the data is pretty damning to the theory, it isn't so much evidence that we have everything backwards as it is that interest rates have very little predictive power over stock performance. Everything we've discussed is under the assumption of all else held constant. But reality doesn't hold anything constant, especially in the stock market. And at the same time that interest rates may be applying downwards pressure on certain stocks in different areas, there are a multitude of other variables likewise influencing performance. Consider, for example, that many interest rate hikes occur when economic activity is robust. So sure, rate hike cycles might slow things down, but that doesn't necessarily mean that companies will see their profit growth materially impacted. Investors also tend to price things into the market well before they actually occur. So we may have already seen the impact from rate hikes priced into our positions. You might have noticed, for example, that high valuation stocks like Tesla and Palantir, internet favorites, fell in value well before the first rate hike in the US, something some speculate was done in anticipation of a rising rate environment. So if investors are already pricing in a number of rate hikes for these higher growth positions, then those rate hikes actually occurring might not have a material impact on the stock's performance. As for gold and crypto, well, it's likewise not so clear how rates will influence prices. Again, theoretically, rising rates should draw money out of gold and value storing assets, and into fixed income positions with higher stated returns. And when it comes to gold, prices do seem to move against yields when you graph the two variables. But gold is also viewed as an inflation hedge. So with rising inflation rates, it's unclear what the overall movement of the asset will be. And for crypto, this will be the first real rate hike cycle we see in the space. So only time will tell if there will be any impact and if the variable will even really matter to performance. It is also worth noting that while everyone is expecting rising rates, there is of course always a chance that things don't play out as expected. Rates were on the rise in 2018, and then a pandemic hit. So you really don't know what will happen in the short term. But what's the takeaway here? Should we go all in on tech stocks and crypto because nothing makes sense anyway? Well, no. This isn't to totally write off the theory behind the negative impact that interest rates might have on the economy, and by extension, the stock market and other investment areas. It's important to take into account the context within which these rate hikes occur. And our current situation could lead to a very different impact than what we've seen historically. Debt levels are currently very high, especially in the US, with the US federal debt to GDP ratio in particular sitting near an all-time high of 125%. And stock valuations have approached an all-time high as well. On top of this, rising rates have been identified as a key contributor to past recessions. So there is a chance that even if stocks do okay, we'll see a broader economic slowdown. So you shouldn't completely discount the impact that rising rates will have. But using rates by themselves as an indicator of where you should cycle your money into and out of clearly isn't a sound strategy. Instead, most professionals would probably agree it's better to diversify across assets that do well in both rising and falling rate environments. But if you are an active investor who owns individual stocks, you can take into account interest rate hikes by incorporating it into your research when you look at a company's financials. You should know how much debt that your holdings have. And many firms will actually report in their filings how much they expect their earnings to be impacted by a rising or falling rate. At the end of the day though, we really shouldn't ignore rising rates. They will mean a lot for consumers and companies, but they're far from a predictor of future performance. The only strategy for that will ensure that you have great returns is hitting the like button and subscribing to The Plain Bagel. Okay, I know that was a cheap one. I'm gonna include it anyway. A quick thank you to Blinkist for sponsoring this video. If you're someone who enjoys learning new things but can't find the time of day to sit down and enjoy a book, I think you'll really like their service. Blinkist is a mobile app that summarizes nonfiction books, letting you read or listen to summaries of all sorts of different titles in typically under 15 minutes. They have some very popular finance pieces on there, as well as books that cover higher economic topics, such as The Black Swan by Nassim Taleb, a book that discusses logical fallacies and economic risks that people pay little concern to until they actually occur. And when they do occur, they tend to cause a fundamental shift in how we view the economy. But if that's not of interest to you, they have over 5,000 other titles on a wide range of other topics. And I actually quite like them for exploring different subjects that I don't think I'll get to otherwise. I'm a particular fan of using it while working away at more menial stuff, because it lets me listen to interesting ideas while still getting tasks done. And outside their core service, they have some new features as well, including podcast summaries known as shortcasts, and even full-length audiobooks, where members get a discounted price. The great thing too is that if you're interested in trying them out, you can visit Blinkist.com/theplainbagel for a 1-week free trial, plus 25% off the full membership fee. So be sure to check out Blinkist. Thanks for watching. I hope you enjoyed the video. If you did find it helpful, a like and a subscribe does really help the channel. And I'd love to hear your thoughts about what you expect to come of this rate hike cycle and what you're doing with your own investment strategy to prepare. Thanks for joining me today, and we'll see you in the next one.